Hey guys, my name is Max Convexity. My channel is your number one source for high yield ETF information. I'm not going to be talking directly about high yield funds right now. I also do a little option content, and so I haven't done some option content in a while. This is going to kind of be a blend between option content and high yield content. The way it ties in with high yield content is what inspired this video is a newsletter that I read every day. In fact, it's my favorite newsletter to read every day. I read two things every day, but one of the things I read every day, especially dealing with the high yield ETFs, I read other stuff too, but dealing with the high yield ETFs and dealing with the market, I should say, I never miss this right here. This is Matthew Tuttle. He's the portfolio manager and founder. He's an option bro, and he's become. I mean, I've become friendly with him. I like Matthew, and I'm rooting for him. I have a couple of his funds, but even if I never met him, I'd read this newsletter every day. So, all right. Well, so I just wanted to cover this a little bit. He talks about his HEAT formula. HEAT stands for hedges, edges, asymmetry, and tail risk. And we're going to be talking about the T today, the tail risk, because that's what he talked about. I just want to read you, or I'm sorry, T's not for tail risk. What's T for? T's for, gosh darn it. It's hedges, edges, asymmetry, and is that not tail risk? What is it? The T is themes. Of course, the T is themes. How stupid could I be? Matthew's a big believer in themes. Drones, robotics, or some current ones. Of course, themes. I'm obsessed with tail risk. My problem, my fault. All right, so hedges. So we're concentrating on the H today. But seriously, this is a good newsletter. I always enjoy his take on the market. Okay, even BlackRock is saying the quiet part out loud. Long-term treasuries don't provide the ballast that they used to do. The bond markets have started 2026 bumpy, with yield spikes themselves to become part of the risk. Two hedges people love that don't hedge when it matters. Bonds aren't a hedge. For 40 years, investors have learned one lesson. When stocks get hit, bonds rally. So a stock-bond mix hedges itself. That's worked in deflationary world where recessions meant yields fell and duration saved you. But in an environment dominated by inflation, uncertainty, fiscal pressure, and supply of government paper, bonds can sell off with stocks, and the hedge becomes a second source of drawdown. That's exactly why BlackRock's 2026 outlook argues traditional diversifiers like long-dated bonds offer less cushion against risk asset sell-offs, and why they've been explicit about being tactically underweight in long-term U.S. Treasuries. Gold isn't a hedge either. And you guys remember Friday? It didn't hedge Friday, did it? I mean, anyway, gold can be a long-run store of value, and it can do great in certain regimes. But as a crisis hedge, it's unreliable because it can get hit by the exact same forces that everything else: dollar strength, margin calls, real rate shock, forced deleveraging. Case in point, Friday's, meltdown. Well, I guess then it happened on Monday too. It continued into Monday. Reuters notes gold and silver extended their plunge as futures exchange raised margin requirements. That's something else that can happen. The exchange can raise margin requirements. And yes, you can own bond substitutes like P&C insurers for income and steadier business models. I've talked about that before, but those are still equities. They can gap down in a real risk-off tape or a real risk-off market. Tape's another word for market that old timers used to say. I haven't heard that in a long time. Well, you hear it occasionally. This tape is crazy. But anyway, Matthew's been doing this for a long time. He's been doing this since the mid-'80s. I didn't even start doing this until the early 90s, but Matthew started when he was like in 8th grade. I didn't start till I was in college. Anyway, okay, so the only real hedge is convexity, tail risk, and that's what I'm all about. It's the theme of my life. I love convexity. If you want something that actually offsets portfolio pain during the ugly moments, you need a real convex payout. And I actually did something similar to this in April of last year. But then the markets, it's not like I'm always on top of it. The markets pulled back a couple times since then, and I didn't have anything on, and I got burned by it. So in any case, but the only real hedge is options. Actually, is volatility. Being long volatility is the only thing that can, you want to buy low and sell high, right? Well, when the market crashes, what happens? Volatility goes up. When the market's going up, what happens? Volatility's low. So the idea is you want to buy volatility before the market crashes, and then the expansion volatility can give you a tailwind or convexity. That's the whole idea. But I love Matthew. I mean, listen to this. There's no magic. A hedge has a cost. You either pay a premium, which is like insurance, or you finance the premium by giving something up, usually upside. The key is to stop pretending diversifiers are hedges, and instead budget hedging like you budget insurance, small, systematic, and designed to show up when the building's on fire, not when the weather's nice. Okay, so anyway, he put a trade in yesterday, it looks like about midway through the day, and it was a one-day trade. It's a trade that expires today. Now, he put it in yesterday, and the market did sell off today, so we're going to look at his exact trade, and I also made you guys something that you can download, or go get it off my Discord. Go get it off. Go get it off my Patreon. I'll put it on my Patreon. But anyway, this is Matthew's hedge. He wrote about this in his newsletter, but I'm going to give you guys this because I think it explains it. I think this explains it a little better. But what Matthew's done, I'm better with pictures than with words, but I made this for you guys. Let me show you Matthew's hedge. I just called it the Matthew Tuttles Siegel trade. And he did this yesterday, and I put in his exact fills and prices. This is a three-leg trade. I mean, how many times have you heard me talk about three-leg trade? I love a good three-leg trade. What's he doing? Oh, he's selling calls to buy puts. This looks like my three-leg risk reversal, what I used to call three-leg risk reversal. He calls it a seagull, and it does. You can kind of see the wing, kind of like a condor wing, or the wing goes up and then out. I don't know if that's why. Maybe you could have a double seagull if it was going both ways. I don't know if that's where it got its name, but I call this a risk reversal. You're selling calls to buy puts, whatever. Great trade, in my opinion. Okay, so let's read the rest of what Matthew said. All the trade is you sold a call that was close to being at the money, and then you bought a call that was further out of the money. The call that you sold was $4. The call that you bought was $2.50. So you made $1.50 there. Then you take the $1.50 and you use it to buy an option. It only pays for about half the option. So you have a $200 debit to put the trade on. Max loss is $500. But it has to go up more than 2% against you. Now, and Matthew's introducing this as an overlay for a long portfolio. So let's say you were using this and you had $100,000 worth of Qs. Well, if the Qs are up 1.8%, they would be up $1,800. This would drag your account down $500, but you would still make $1,300. Anyway, when so let me read you his description. That's basically all it is. He sold a call spread to buy a put spread all in the same time frame. He did it yesterday for today's expiration, and he's talking in his newsletter. Go read it. You could do this every day. He's calling this an overlay that you could use on top of an existing long portfolio. I just made the $100,000 up. You could have, I'll explain it more here in a second. So let's go back to what he's saying. I just get excited about these things. You guys, I have to excuse me. Okay, so like I said, he sold a call for about $4, bought a call for $2, used that money, turn around, that brought in a couple $100. He bought a put that cost $350, and that gives him the tail risk protection. And just to be fair, right now his trade that he put, it cost you $500 margin to put it on because that's the max loss, and it would take $200 out of your account when it came on. But right now the thing's up. Let's hit refresh. Let me go back to save trades. Okay, yeah, Matthew Tuttles Siegel trade. It's up $543. Because the put that was halfway paid for. Basically, the call spread pays for half the put. That's the only difference from my strategy. My strategy, I try to make the call spread pay for the entire put and leave a credit left over. Anyway, don't worry about my strategy. So yeah, this thing's up about $500 on about $500 worth of risk right now. All right, so let's see what the market's doing. I don't know if anyone saw my morning update, but I drew this green line and said it would probably hit here. But if it did, it might be a place to buy the dip. I'm not saying buy the dip, but when I saw Matthew's newsletter first thing this morning, I wanted to put on a different idea. I love to look at because I have a max convexity hedge that I use, and I wanted to see if it has more potential than his or whatever. So anyway, so let's look at that. Okay, so mine is Max's alternative for Matthew's idea. And we didn't, I mean, this isn't, I'm not saying this is fair and that my idea is 3 times better than his. I put this on at a different time. I had the benefit of seeing his idea first and then trying to make a better idea. If I showed him my idea first, he could probably find a better idea. It's just, I mean, or a different idea, whatever. Just an alternative idea, not financial advice. But I've been showing you guys this before I showed you guys this before in SB, actually like this trade. This trade's complicated. It's just the max convexity hedge. What it really, if you want to look at it like this, I'm trying to explain it to folks. This right here is called a reverse. This right here is called a reverse calendar trade. You're selling a put that an at the money put that expires tomorrow, but you're buying a put that expires today. Now, and this brown thing is not really there; it's excluded. This is just it's a volatility strategy. You just want volatility to go one way or the other, and you can make money. This is a trade, a reverse calendar, a RIC, or reverse. They call RICs reverse condors sometimes, but you can look up reverse calendar. That's a trade that people do sometimes. It doesn't give you tail risk though, because you don't have unlimited upside on the downside. Okay, so what I like to do to make it tail risk is use the same thing, but double the units of long puts that expired the day, tomorrow. Okay, the problem, and this is a great trade. You have tail risk, you get a credit. If the market goes nowhere, you lose money. But if the market goes up, this is to put on every day. If the market makes a big move up, you'll this trade doesn't cost anything. Unlike Tuttles trade, where if the market goes up 2%, even though your idea still makes money, this doesn't drag on a bullish market. It just drags in a market in the middle. All right, but the reason you don't want to do this is because brokers discourage you from doing this. They'll sometimes charge you naked margin. What happens is when your longs expire, let me just exclude this. When your longs expire, you're left with a naked short. Your longs expire at the end of the day tomorrow, and then you have to go through the whole rest of that day tomorrow naked short puts. Obviously, you have to close that. This is kind of a complicated trade, but you need to close it out. You don't just leave it naked. But the thing is, because brokers don't trust you to always do that, they might just charge you the 12,000 margin to put on the reverse calendar off the get-go. So here's the way we alleviate that. Now remember, it's a reverse calendar. It's a ratio reverse calendar because it's a 2-by-1 ratio reverse calendar. So there's the base trade right there. What I'm doing with this other put out here is making it where this put expires tomorrow, and it's a bot put, so it's covering your sold put. It's for margin control, and it's so like if maybe I go to the park and meet a good-looking girl and forget to close my position, start talking to her and forget to close my position, and then I get a text that they've sold up me or whatever. I get a margin call or something. You don't want that to happen. Well, if you do it like this, if you add an out of the money put, it actually has more tail risk protection because you have one more put. You now have 3 long puts, so that's bearish protection, and you only have 1 short put, which is a bullish trade. But the short put is enough to offset. So look at the way I do it. So the short put you could have sold for $4 this morning when I did it. I just did it what the market was trading at about 9 o'clock. So you could trade at $4. Now it's trading higher than that now, but it's trading at 11. But you could have sold it for $4, so that brings it to $400. You sell this one for $1.50 a piece, so that's 308 against. So you're plus 409 minus 308, so we're plus 101 right now. And then with that money, you buy You know, you have to go out and you buy whatever call you can afford. So you do it for a credit or just free. So it's basically a free trade. How the market beats you is what Matthew calls a quiet tape. If you do this every day and you have a quiet tape, or you have a lot of days where, like the market was at 624 when I put this on. So, you know, if the market would have just gone, and that was, okay, that's 2.1% away from here. If the market would have just dropped a point, which is a lot, you know, down to 1.1, this trade actually, that's not enough. This trade probably would have, or, well, if the market dropped a point from there, the trade would have made slight. If the market only dropped half a point or a quarter point, and it does that a lot, or not moved, or gone up, you know, or maybe gone up a half a point or a quarter point, that's how you get beat. But this is an overlay. The way Matthew sells this is his strategy anyway. And my strategy is the same thing. It's just a different way to do it. I'm just calendarizing his strategy. And I think I made it better because it has more, it has tail risk. Like it has more tail risk because he only has one put down here. So we didn't put them on at the same time. So it's not an apples to apples comparison. So, but I also don't, and I also think mine's better because if the tape turns bullish on you and the market goes up, you know, 1% or 1.5%, you aren't looking at a, you know, $1,500 gain and then a $500 loss. You're losing a third of your profits on kind of small up moves, you know, a 1 point up move. Anyway, so I just think the reverse, this is a defined risk ratioized reverse calendar, defined risk ratio calendar, ratio reverse calendar, defined risk ratio reverse calendar. Anyway, all right, so let me show you, if you're interested in this, and you probably still are if you're watching by this point, it's time to take this one off. We've hit our, so what you could do is if you did this one every day, when you hit your downside profit target, when you think the low for the day is in, you can take it off and put another one on. The idea of this, and the way Matthew's talking about, is to do this every day, especially during times when you think the market's going to fall. If the market's doing great, but it's, you know, you could put this on. Let's say you thought the market was going to fall over the next month. You could do this, you know, every day. Like he's saying, make a small budget. And here's what I do. Use this on a $100,000 account. Market doesn't go anywhere. You're out $280 at worst. That's 0.25%. Okay. But the market drops, you know, 1.5 down, and that would be about a $869 profit. And if the market moves up 1.5, I'm extrapolating where it came from. 2.3136. If it moves up 1.5, you have a slight profit, $53 profit or whatever. So it doesn't hurt you. You're just trying to miss this number in between. But you could budget this each day. If the market doesn't move, what Matthew calls a quiet tape, it's going to cost you about 0.25 point a day. But if you can get one outsized move somewhere like we're having today down there in the month, you know, you can do pretty well. All right, so let's pretend like let's just do this. Let's do the same thing, but for the 4th and the 5th, so I can show you my idea. And if Matthew'd like to come, we should have Matthew on the show one day. He could show it. He could explain his Siegel idea better. I think you could call my idea Siegel too, because the profit and loss profile has that. I always thought the Siegel was that kind of look like that reverse calendar kind of look. I always thought that was a, but I think this is a form of a Siegel also. I think you could call mine's just I just calendarized Matthew's trade and moved the strikes around. But I just calendarized it and I added extra strikes because I like to be, just because it's the way I did it. It's this trade is net long volatility. Matthew has a short option, a long option, and a long option. So but my trade has a short option and 3 long options. So like if volatility doubled between days, I know it's hard to see that, but it actually makes, like if volatility doubled, the profit on this move right now is what, 1,500, but you know, I'm just using double. I know it usually doesn't do it, but it goes from a $1,500 profit to a $1,638 profit. Anyway, volatility going up is a tailwind. It doesn't hurt. Volatility going down is actually what hurts this trade. All right, so let's set this up ourselves. We're going to call this the max convexity reverse uh, maximum XD reverse calendar hedge. So what you do is you hit build, and you hit what it is it is a, let's just set it up. Let's set it up like this. Let's set it up as a put calendar on Qs. Puts usually on indexes, puts are overpriced relative to calls. On indexes, on stocks, not necessarily. We'll just start with puts, but you could try with calls also. All right, so first we have to ratioize the put. We have the days in here, right? 4th and 5th. We have to ratioize the reverse calendar. Oh, it's not a, this is not a reverse calendar. This is a forward calendar because this one, the short expires tomorrow. And if this one expires, you're just left with the long. So this one doesn't have any margin problems, but it doesn't also do what we want. We want the short to expire after the long. All right, that's what the reverse calendar looks like. I mean, I think that could kind of looks like a seagull, whatever. And yeah, reverse calendar put spread, right? And then we're going to ratioize it. This is a ratio reverse calendar put spread. All right. That gives you tolerance. You could do that trade alone. That's fine, but you can't go to the park and start talking to a good-looking girl and forget to close your position, or you run the risk of creating a black swan in your account balance. You know, if you, you know, the market, something happens after hours, the market's way down and you're naked puts, and then in the morning that's not good. So I just think it makes it cleaner to just cover this because this is a short put. So this means you agree to buy the market at 613, but you don't want unlimited risk. Stock has unlimited risk on the downside. Selling a put has unlimited risk on the downside. What you do is you add a buy put, go about 5 strikes away, wherever you can make the money work. So then what I do is I'll vary the strikes a little bit to make it where a big up move is actually not a problem. And we can do that by all right, we could do something like that. I'm not able to make this work out as well as the one today worked out because volatility's gone up. That's the idea. You want to put these on before volatility goes up. Let me mess with these strikes a little bit. Let's just forget about the protection. Let's just exclude that for a second. If you forgot about the protection, you could do that. And then you have, in a big up move, you're not hurt. And if it moves down more than 1.4, you have black swan protection. Okay, so that's for a credit of $100. We should be able to put this one on, and it should be still for a small credit. Let's include this. Yeah. Anyway, all right. We'll just pay. Obviously, we're going to pay per trade and see how it goes. It's not near as attractive as yesterday's trade was. Essentially, it's like it's not free insurance. You could put it on, you know. Reverse calendar ratio spread. I'm trying to think and come up with a good acronym. Do you guys could you guys think of one for me? Rascal, anyway, whatever. All right. We'll just see how it does. Go read Matthew's newsletter. All right, and we'll just follow all 3 trades. Matthew's trade is looking good too. It's up $347. If you did that one, you could do the same thing. That just to show how Matthew's works, let's take it off and put it on again. So Matthew's trade, we're just going to sell a call spread. I'm seeing how they did yesterday. He sold a 3-point white call spread, and then he went 3 points in the other direction and bought a put. Okay, so we're going to build a bear call spread. Okay, and we're going to sell and at the money, go 3 points out of the money. It may not, yeah, because that's a He sold this one, bought this one, maybe like that, and then he's using this credit to buy a put. Let's just buy whatever put we could afford that pays for half the debit, because that's what he did. I don't know if that's what he's trying to do, but net debit's $143, and this is at $200 and almost $80. Yeah, there we have it. The debit's about half paid right there. You may want to pay a little bit. If you pay a bigger debit, you get closer protection. You know, you need a 0.7 of a point drop to 177. Max loss $400. Oops, sorry. All right, that's close to yesterday's. If it goes nowhere, you lose $200. If the market goes against you, you're going to lose 500, more than 500, because volatility's expanded. These options it's going to be more expensive to put on this position. Because remember, you're buying two options and selling one option. This is a net long volatility trade. This is long volatility. This is a hedge. All right, let's just save it. Well, let's just save it. Let's save this as a new trade. Let's see. Idea for math. Or let's see here. All right. So let's just compare both these trades. Let's see here. Let's open up, because we did them at the same time. So let's see how they compare. I did for Matthew, and then there's the max convexity spread. All right, so we open this one in one window, and we have the idea for Matthew tomorrow in the other window. Okay. I'm not saying mine's better. It's just different. It's just different. It worked out today better than his did, but the problem with what I'm doing when I'm calendarizing the trade, the drawback to any calendar trade that is you put them in option strat and or whatever back software you have, they looks good in the software, but what happens in real life is your shorts and longs lose. The shorts and longs have a more dynamic relationship about at the rate at which they lose or bleed theta, and option programs can't figure it out. It's true that this is the max loss. They can figure out your max loss, but it's kind of, sometimes it's, the calendar trades traditionally look a lot better in simulators than they do in real life. Sometimes you're better off just not to mess with the calendar. Anyway, all right. So, but let's see. So my idea, on the down move, I need 1.8 before it starts. Let's see how much. Okay, mine ties up $700. So let's see how big a move it takes to get your $700 back. All right, about a 2.6% move down. Now Matthews starts making money sooner than mine. I just don't like how if the market bounces and goes against you, you lose $500. I'm fine with the market not going anywhere and you lose a couple $100. You just budget that. That's fine, because every once in a while you do get a 1.5% down day and you get $500 to the good side. Of course, occasionally you get a 1.5% up day and you have 500 to the bad. So anyway, all right. Well, that's Matthews. Well, we'll just keep an eye on them. That's Matthews' concept, the 3-leg. It's a selling calls to buy puts. And here's the calendarized, ratioized version of the same trade. I think my idea has better tail risk, but it takes you need a bigger move before the protection kicks in, at least based on the way I did it today. But let's say like in a 7% risk off move, like a limit down, 7.5% risk off. My idea would be up 6,800, and his idea would be up 4,200. But I snuck an extra put in there to give it some extra tail risk protection. All right, guys. Well, thank you so much for being here. I appreciate you guys being here. I hope you like the option content. I'm pretty sure most people are gone by now, but I'm basically making this. I want Matthew to look at this. Matthew will probably look at this maybe, or maybe not. He has bigger fish to fry. But also maybe SV and BR will take a look at this, or some of my other option bros, and give me your opinion on it. I'd love to know what Scramble Anything thinks about these types of trades. I'd love to know what Soxel or we have a lot of option traders. So anyway, I'm just trying to get the dialogue started. Maybe we'll start doing some more option content. In the meantime, I'm going to start paper trade. We'll do this every day for a month. We'll do Matthew's strategy and my strategy. And every day at one, we'll just use one as the time to put on the trade to go for the next day. We'll mechanically do an overlay. All right. Then if you guys have ideas for a better overlay, maybe we'll test a thorough. Let's just put in an option strat every day and kind of see how it goes. I'm going to show you one other thing I really like about mine. Let's say the volatility doubles overnight. Okay, but the thing is, if lots of times the volatility goes up, the market's crashing. So if in a down move, you know, the market sells off a couple percent and volatility goes, okay, market sells off a couple percent. This is up $974. Volatility is up 50% overnight. It's still down the same 2.5%. This is worth 1,100. So it's sensitive to in down moves, you get a wind at your back. You don't want a move that goes nowhere. If the market goes nowhere, it beats you. You get beat by this strategy. All right. Well, anyway, we'll see how they do. We'll take a look at them. Thank you so much for being here. Go to my Patreon. I'll put the link. If you guys want to download this to study it yourself, and I'll make one like this for my trade too. Anyway, I'll go put those in Discord or Patreon or somewhere where you can get them. Thank you so much. Have a good day.